Hello from Istanbul, Atilla Yeşilara, broadcasting from the Real Turkey channel, the only real Turkey channel from Turkey giving real news in English. Well, English may not be real. Today, I'm going to talk about Turkey's corporate debt problem, which is the best kept secret in Turkey. I'm 60 years old. And my testosterone level is negative, so I can't rock climb, windsurf, mount a horse, or mount anything for that matter. So, you have to have a hobby because I have another 40 years to live thanks to the longevity drugs. And I read investment banking reports and collect data on bankruptcy protection cases, or Americans would call it Chapter 11. French would simply go to Macron and beg for more money. I am sorry. No more French jokes. No. I had a French croissant this morning that has that effect on me. In Turkey, corporate debt is a huge problem, but it's denied by the whole by debtors, by creditors, and by the government through various means. The corporate debt is a problem, if you ask International Institute for Finance, for most of the emerging markets, as well as for low credit rating or junk American corporations. In fact, Fed Dallas Reserve Board Chairman Mr. Kaplan said in terms of if there is a downturn, he would be very worried about a corporate debt balloon exploding because there are a lot of very low-rated companies with weak covenants borrowing money at very narrow spreads. Turkey's problem is not unique, but the way we prefer not to deal with it or play musical chairs with it is unique. For instance, China is trying to deal with it effectively, or it has the resources to deal with it if it comes down to it. Let me give you a few examples of how severe the problem is, so that we can establish a sense of the grounds that we're walking on, and then talk about the analytics of the case. As I've said, I'm collecting data on these bankruptcy protection cases, and I'm also going to, throw in work stoppages and bankruptcies as well. Sarar is one of Turkey's leading apparel companies with branches in New York and other Western capitals. Very well-known brand. I wear Sarar myself. Has recently announced it's shrinking by 15 to 20%. Many brick and mortar retailers are shrinking in the West because of competition from Amazon and internet sales, but this is not the case in Turkey. Internet sales in Turkey are like 4% of non-food retail. So that's not Sarar's reason. It's just not profitable. Boyner, another very distinguished company, had similar problems. It is disposing assets. Borajet, right? Borajet, an airline company, as the name suggests, which is well known in the tourism community that fetches a lot of tourists to Turkey, had suspended operations. Goodyear, an international tire company, had to suspend work in its factories for 15 days. A logistics company, and I shall not name names because sometimes I mispronounce them and I get threatened by a lawsuit, in Istanbul, has just gone for Chapter 11 bankruptcy. We had several natural gas conversion power plants which are in bankruptcy proceedings. Recently, the chairman of a private bank, Mr. Atesh of Denizbank, said $2 billion worth of tourism loans had to be restructured. I mean, imagine, we had the best tourism season in the last 5 years. So many construction companies have applied for bankruptcy protection or gone bust. The list would take hours. You might say, well, there are more than 1 million companies in Turkey. So, a total at the end of the year will have 4,000 or 5,000 such cases. It's statistically insignificant. It is not so. If you look at the distribution of these companies in distress across the economic activities, as well as their geographical spread, I mean, not only Istanbul, but other major industrial cities like Bursa, Kocaeli, Manisa, and Denizli are reporting increasing numbers of either bankruptcies or bankruptcy protection cases. And as well, according to collection agencies, the number of cases has doubled over the last year. You realize there is a problem. And in fact, there is a problem. The problem is that Turkish companies cannot generate enough EBITDA, enough cash, because Turkish economy has shrunk so rapidly. More importantly, Turkish companies carry a lot of foreign currency debt on their balance sheets, which they borrowed when Turkish lira was stable and foreign currency interest rates were much lower, in the hopes of converting this debt into factories, production, and exports, which just didn't pan out. As a result, they're stuck with foreign currency debt, the Turkish lira value of which is increasing steadily, but their Turkish lira revenues are not increasing. So there is a huge problem here. I mean, let me put it this way. In the next 12 months, Turkish private sector, so that's excluding the state, will have to pay off or roll over $160 billion worth of foreign debt. About $100 billion of that is commercial debt. That's debt arising from exports and imports. So it will certainly be rolled over. But roughly $60 billion or so is loans borrowed for other purposes for which there is not enough collateral or cash flow. In fact, once again, according to the International Institute of Finance, Turkey is one of the most FX-stressed countries, and in any kind of shock or panic scenario, it doesn't have enough central bank reserves to help the private sector pay off these loans. So you would expect the government to do something about it. I mean, a resolution process, one where the corporations, the banks, and the government get together and discuss solutions like China has done, debt equity swaps or some kind of recapitalization of banks or so. No, this is not how we do things. That would be wrong. That would be Western, alien to our culture. Instead, we have unofficially classified companies into two categories. Those too important to die, and the rest, which in itself is logical if cruel, if done properly. I mean, if a company can survive, then yes, it should be helped. And if it is hopeless, well, then you leave it to your fate. This is how capitalism works. But in Turkey, that classification is not necessarily made on the basis of merit or the company's operating success, but usually about whether the company boss is a member of the ruling party or not. So we have a lot of zombie companies which are being allowed to survive simply by state bank lending or by a kind word to the private banks, or being allowed to declare Chapter 11, bankruptcy protection, and a lot of good companies in temporary distress which are going bust. When a company goes bust, of course, its suppliers, which are usually small and medium-sized companies, go bust as well. Another way the state deals with this problem is it's putting active pressure on Turkey's banks to restructure loans, that's to defer loans and to offer easier payment terms to borrowers, which again is a common practice in the West if the bank believes the company will eventually return to solvency. The problem in Turkey is, once again, the standards determining future solvency are extremely lax, and usually the matter is decided simply by the question of whether the owner of the company is a member of the ruling party or not. As a result, Turkey's non-performing loans have risen to over 5% from 3% over a year, and according to the latest World Bank report, still 12% of Turkey's loans are shaky, in distress. not making regular interest payments. Finally, Turkey found an ingenious solution, which is to buy a foreign credit rating agency to give companies better ratings so these loans can be floated, it's called evergreened, for another 2 years. So banks won't have to write them off and won't have to suffer capital losses. The name of the company is JCR, Eurasia Group, which was bought by Turkish banks and Turkish Istanbul Stock Exchange and Turkish Capital Markets Board. You can read about it in Bloomberg. So Turkey's approach to the problem is, if we turn our head away or if we bury it in sand, the problem will go away. But it won't, simply because Turkey will not grow enough in the next 2-3 years to generate the kind of cash flow for the currently insolvent or near insolvent companies to become solvent. And the banking community is slowly coming to realize that. Very recently, UniCredit, one of the first foreign banks to strike a joint venture in Turkey with Koçbank or Yapı Kredi Bank, they are the same, has decided to reduce its share. Of course, one may argue it's not doing so because of the lack of profitability in the banking sector. But if there's a report in Deutsche Welle. If you talk to, members of the private banking community, UniCredit has essentially given up hope on making profit in Turkey. And rumor has it that UniCredit also doesn't like the macroprudential standards established by BRSA, which simply don't accord well with the European banking standards, and decided to pull out. Again, according to the same article in Deutsche Welle Turkish, UniCredit may be the first one of the Western banks to pull out of Turkey. To recall, HSBC, ING, the Spanish bank BNNA, BNP Paribas, are all in Turkish, and roughly 50% of Turkish banking system by balance sheet is owned by foreigners. Some of it, of course, is Arab capital or Russian capital, which is not interested in these issues. But if Westerners pull out, or if they decide to reduce their stakes in Turkish banking community, Turkish banking system will shrink. It will be able to make less loans, which means more corporate distress. So it becomes a vicious cycle and everybody loses. So Turkey's corporate debt problem is a very serious problem, which the government simply ignores and pretends that everything is getting better, which essentially is another doom case scenario. I read the comments that you send religiously. First, there is apparently Turks are watching this. I don't know why, because I also shoot Turkish videos. There is a Google Translate function available, which, you can translate into Turkish or into English if you want to. And, we will soon start Chinese subscripts in Mandarin, not in Szechuan. And I hope people from other nations can start watching our show as well. We want to thank you for watching Real Turkey channel and hope to be here next week. Don't forget to subscribe or share it with those who are interested in Turkey. Bye bye now. This is Atilla Yeşilara.